On Wall Street, there are two kinds of people: those who chase alpha and those pretending they already found it yesterday. Both of them are now obsessed with something so dull, so lifeless, that it makes government bonds look like rock concerts. Not stocks, not crypto, not real estate, not even the buzzword of the decade: artificial intelligence. It's something called private credit, the most boring-sounding asset class that's quietly minting billionaires faster than TikTok trends explode. Somehow, this corner of finance, dull enough to sedate an accountant, has become Wall Street's hottest new obsession overnight. And the strangest part? Hardly anyone outside the financial world has even heard the term, let alone understands what it means. That mystery sent me down a 2-month rabbit hole into an industry most people never realize exists, yet it moves trillions silently. What I uncovered was a secret engine of credit, risk, and greed that's quietly reshaping global finance from the shadows. But to understand how this monster was born, we have to rewind the clock back 2 decades to the early 2000s. Back then, banks were giving out loans faster than college freshmen hand out resumes at an investment banking career fair. You didn't need income, or assets, or even a stable job. Just a heartbeat and a half-decent smile. They called them ninja loans. No income, no job, no assets. Yet somehow everyone walked out with a mortgage. It was financial Oprah. You get a loan, everybody gets a loan, until the music suddenly stopped. When the global economy crashed in 2008, 9 million Americans lost their homes, and Wall Street nearly imploded under its own arrogance. Regulators rushed in, determined to play the role of strict parents after years of letting the kids run wild with leverage. Overnight, banks were forced to hold more capital, cut risky lending, and basically stop having fun altogether. Borrowing from a bank became harder than getting Taylor Swift tickets in under 3 seconds after they drop online. And where there's a void, finance behaves like nature. Something always rushes in to fill the gap. That something was private credit, the rebellious cousin of traditional banking who doesn't bother asking for permission. Imagine you're a company in trouble, desperate for cash, and the bank says, "Sorry, we don't do that anymore." Then a fund manager from Apollo calls and says, "We'll lend you the money, no collateral needed, but it'll cost you." These deals cut out banks entirely, connecting billion-dollar funds directly to companies that need quick, risky lifelines. No depositors, no regulators, no public disclosure. Just pure, unfiltered capitalism with expensive suits and even pricier coffee. Private credit became the Venmo for corporations, except instead of $20 for pizza, it's $200 million for survival. By 2010, this shadowy system had tripled in size, while most investors were still too busy watching the stock market recover. From $140 billion in 2007, it exploded past $2.5 trillion. Yes, that's bigger than Canada's entire GDP. In little more than a decade, private credit evolved from a niche sideshow into one of Wall Street's main attractions. The reason for its rise is simple. Banks got cautious, but the appetite for risk never truly disappeared. Private lenders stepped in to do what banks couldn't or wouldn't, lending to mid-sized companies on their own terms. It's like a bespoke suit for debt, custom fit, high-priced, and available only to those who know the right people. These loans promise juicy returns in exchange for being just risky enough to make bankers sweat and investors drool. For big players like Blackstone, Apollo, and Ares, it became the ultimate money machine. Predictable, scalable, and invisible. Institutional investors loved it. Pension funds, endowments, and insurance companies all wanted in on the quiet revolution. After all, who wouldn't want stock-like returns without the emotional chaos of daily market swings and CNBC panic alerts? Over the last 2 decades, private credit returned around 9.6% annually, just a hair below the S&P 500's 10.2%. But while stocks danced like caffeine addicts, private credit moved like a metronome. Steady, boring, reliable. In a world addicted to volatility, boredom suddenly looked like a luxury product that every investor craved. The phrase stable returns became a kind of financial aphrodisiac whispered in every boardroom across Manhattan. Private credit offered exactly that, a middle ground between risky equity and dull government bonds. Pension funds, managing over $30 trillion, saw it as the Goldilocks solution. Not too risky, not too safe, just right. And after a decade of near zero interest rates, Investors realized that stability itself could be a goldmine. They weren't chasing excitement anymore. They were chasing sleep, the kind that comes from predictable quarterly payments. But beneath that calm exterior lies the same flaw that haunts every too-perfect financial invention. Nobody really knows what these loans are worth because there's no centralized market to check the price. No tickers, no daily quotes, no liquidity, just spreadsheets and optimism. In private credit, assets are worth whatever managers claim they're worth until a borrower stops paying. When defaults happen, everyone suddenly remembers how little they actually understood about those safe returns. It's financial theater. Everyone plays along until the curtain falls and someone checks the books. Many of these funds even borrow money to make loans, layering leverage on top of already leveraged assets. It's debt stacked on debt, gift-wrapped as innovation, and sold with a confident smile to institutional investors. As long as borrowers keep paying, the illusion holds. The second they don't, the music stops abruptly. Yet billions keep flowing in because denial on Wall Street is more addictive than profit itself. Investors know the risks, but they're willing to ignore them for one simple reason: returns feel too good to question. It's the same psychology that fueled every bubble, from housing to crypto to tulips in the 1600s. Maybe private credit really is the future of lending: efficient, direct, and modern. Or maybe it's just the latest bubble wearing a three-piece suit and a charming smile. Either way, it's now a $2.5 trillion reality, powering the global economy in near silence. As long as the interest payments keep rolling, nobody's asking uncomfortable questions about what's underneath. But every party on Wall Street ends the same way. The lights flicker and someone's left holding the bill. So the real question isn't whether private credit works, but how long the music can keep playing before it stops. To understand where this could go next, we have to zoom out and ask, what really makes private credit so powerful? It thrives on one simple truth. Banks are slow, but greed never waits for paperwork or permission. When regulation locks the front door, innovation quietly slips in through the side window with a suitcase full of cash. Every time the government tightens lending rules, the market invents a faster, riskier workaround that looks safe until it isn't. That's exactly what happened with subprime mortgages, collateralized debt obligations, and now with this trillion-dollar shadow lending machine. The same human pattern repeats: profit now, consequences later, and hope the music plays just a little bit longer. What's fascinating is how private credit disguises itself as innovation, when it's really just leverage in a different outfit. Debt has simply been rebranded as opportunity, a shiny new name for an old addiction. Some of these loans are already stretching risk boundaries, funding companies that traditional banks wouldn't touch with a 10-foot pole. Borrowers love it because it's fast money. Lenders love it because it's private. Regulators hate it because it's invisible. And that invisibility is both its greatest strength and its biggest weakness. When everything goes right, nobody asks questions. When it goes wrong, nobody knows who to blame. That's the same structure that nearly collapsed the financial system in 2008, just with better branding this time. Private credit isn't inherently evil, but it lives in a moral gray zone where profit outruns prudence. Every successful industry on Wall Street begins this way: small, efficient, and ethical, until the money gets too good to resist. Today, everyone from pension managers to sovereign wealth funds is piling in, convinced they can exit before the music stops. But bubbles never send calendar invites. They burst when confidence quietly disappears, not when profits peak. And confidence is exactly what private credit feeds on: faith that borrowers will keep paying no matter what happens. So far, that faith has paid off. Defaults remain low, returns look stable, and everyone seems comfortably numb. Yet beneath that calm surface lies leverage stacked like Jenga blocks, waiting for one wrong move to shake the tower. Imagine thousands of private loans linked together, each one dependent on the next for liquidity and valuation. If just a few pieces crumble, the ripple effect could travel through pension funds, insurers, and entire economies. We've seen this movie before. It just keeps getting remade with new actors and a bigger budget. Back in 2008, it was subprime mortgages. In 2020, it was over-leveraged tech startups. In 2025, who knows? Every generation of investors believes they're smarter than the last, until the same lessons return in different packaging. Private credit, at its core, is a story about control. Who gets to decide what risk is worth taking? For now, that power sits in boardrooms of trillion-dollar funds that face almost no public scrutiny. They make decisions that shape markets, yet they answer to no one except their own investors. It's capitalism distilled to its purest form, invisible, efficient, and dangerously dependent on trust. And trust, once shaken, disappears faster than liquidity in a crisis. So the question isn't whether private credit will fail, but how much damage it could cause when it eventually does. Maybe it unwinds smoothly, quietly shrinking without breaking the system, or maybe it's the spark for the next recession. Either way, the stakes are enormous because the world's safest money is now deeply tied to the world's riskiest loans. Pension funds, university endowments, and insurance companies all depend on the assumption that nothing will ever go wrong. But as history reminds us, nothing will go wrong are the four most expensive words in finance. Still, optimism sells better than caution, and greed has a much better marketing department than prudence. So investors keep nodding, collecting yield, pretending risk has been reinvented instead of just renamed. The truth is, Wall Street's talent isn't innovation, it's storytelling. They sell confidence wrapped in spreadsheets. And private credit might just be the best story they've told in years. It's clean, profitable, and conveniently opaque. Everything a money manager could possibly dream of. But beneath that dream lies a system addicted to growth, where every dollar lent needs another dollar to stay alive. As long as interest payments keep rolling, the illusion of stability remains beautifully intact. Yet the same illusion once surrounded housing, tech, and crypto, right before reality crashed the party. Private credit could be different, or it could be déjà vu with better suits and smarter PR. Nobody really knows, and that uncertainty is both thrilling and terrifying to watch unfold. Because finance, like human nature, never truly changes, only the acronyms do. Behind every chart, every deal, and every shiny promise, it's always the same story. Fear and greed dancing in circles. The music keeps playing, investors keep pretending, and somewhere deep down, everyone hopes this time is different. But it never really is. It just feels new until the lights go out and the silence begins. Maybe private credit truly will revolutionize lending. Faster, smarter, and more efficient than anything before. Or maybe it's another ticking time bomb, disguised as progress, waiting for one bad quarter to set it off. The irony is that everyone on Wall Street already knows the risks. They just choose not to look too closely. Because in finance, curiosity is expensive, and denial is profitable. So they keep dancing, keep lending, and keep calling it innovation instead of what it really is: leverage. For now, the party continues and the music still sounds beautiful, even as the floor starts to shake. Investors smile, funds grow, and regulators whisper, hoping the system holds just a little longer. But deep down, everyone knows how this song usually ends, with silence, regret, and a brand new acronym for disaster. Until then, the story goes on, the money keeps flowing, and the headlines stay quiet. Because on Wall Street, as long as the check's clear, nobody dares to ask who's paying the real price. So maybe the only real question left is this: when the music finally stops, who will still be standing?